And we're live and recording here for those of you who can't join the live version. It will be recorded and available afterwards. But on behalf of the Stanford Professionals in Real Estate Group, also known as SPIRE, I'd like to welcome everyone to our Fall 2024 webinar. For those of you who don't know SPIRE, we're a Stanford alumni group focused on the real estate industry in all of its components. SPIRE seeks to connect, support, and educate and empower alumni, students, and the broader community that's interested in real estate, placemaking, and the built environment. We do a number of things throughout the year. Part of our mission is education and sharing ideas. And this webinar series is designed to periodically address a relevant topic with experts who are active in the field. Today, we're going to cover a very relevant topic, which is where's the money? Where's it coming from? Can I get any? And we're going to have with us three experts in that field who are very active in how capital is or isn't flowing into real estate. So with a brief introduction to our panelists, I have first Lindsay Bachner. Lindsay is a managing director at Evercore Real Estate Advisory Group. The group is part of the broader Evercore Investment Bank and is one of the leading fund placement, secondary market, LP, sales agents, and fund recapitalization advisors in the world. Lindsay covers both large institutional investors in the US and Asia Pacific and works with GP sponsors. Second, Mitch Pleiss, as he says, rhymes with ice. Mitch brings the principal's perspective, having recently retired as real estate portfolio manager at the California State Teachers Retirement System, also affectionately known as CalSTRS. CalSTRS is one of the largest global pension funds. I think it's now over 350 billion of assets under management. Real estate represents approximately 50 billion. So one of the largest real estate investors in the US and even more broadly the world. And last and not least is Rob Rubano. Rob is head of US Equity, Debt, and Structured Finance Group for Cushman & Wakefield, which is one of the world's largest global real estate advisors and service providers. Rob leads a team working closely with owners, borrowers, and investors to develop and implement creative solutions to achieve their objectives. So we have sort of all bases covered here on the capital side. And I'm going to pose a series of questions and topics to the panelists. We plan to go through those, but we also hope to have time for audience questions. So if you have any, I don't see on my screen, but hopefully Alex or Lauren, who are monitoring this, we'll see your questions pop up in the chat section, and we'll try to get to them during the course of this webinar. I believe we have 1 hour set aside. That's sort of what I'm planning, unless someone wants us to go longer or shorter, but 1 hour is what I'm planning on. And we'll get right into it. So first question is, you're starting to hear and read a little bit about these murmurings of a thawing in the real estate capital markets. But then I talk to many people out there trying to raise money, and they're sort of like, if it's thawing, the ice is still really thick. And wanted to get your perspective on, sort of what's going on right now and how you see things evolving over the next 12 months. So any of you want to take a shot with that first?
I'm happy to dive right in. Given my role, we are working with a number of clients who are actively trying to raise capital for real estate funds and co-invests and programmatic joint ventures. And you're absolutely right. It's been tough for the past couple of years, and that's no secret. I would say, as I talk every day to investors across the globe about 2025, and that's really the focus now that we're sitting here on November 1st. It's kind of, for most, hey, our allocations are done for 2024. Either we have agreed to what we're doing next, or we're just out of capital for the year. So full attention is on to 2025. And I would say the sentiment is significantly better, meaning that investors are saying, I don't want to miss this vintage. I am excited about what's to come next year. I do believe there is opportunity to do well by investing in real estate, but there's a big but. And that but is, but we are still suffering from a lack of return of capital. And so 2 years ago, when you talk to investors who were pulling the back, it was because there was something called a denominator effect, and that was because their public markets portfolios were suffering, and so real estate as a percentage looked outsized in their portfolios. That has abated. The problem is not at all denominator effect. The problem is lack of return of capital. And we all know the transactions market broadly have been quite frozen or very, very close to frozen. And so with that, investors who typically expect cash flow distributions from their real estate investments or return of capital as assets are sold, they simply haven't been getting those. So while I would say I'd kind of culminate by saying, well, the sentiment is strong that investors want to be active in 2025, many of them, certainly not all, but many of them are still suffering and being forced to hold back until they see more of that return of capital come back into their pockets. So we're all hopeful that the transaction market increases significantly as a catalyst to help that happen.
So Mitch, you were recently at CalSTRS. I mean, you look at it from the outside, you got $350 billion. You got to have some money for real estate. How, does it impact CalSTRS, or how do you look at it?
Yeah, I think I agree with what Lindsay has shared. One of the things that I think the pension funds are doing that they haven't done 2 years ago is really develop capital plans. How are we going to spend our money? And I think that's a change. And pacing has become a big issue. How is the money going out? Who's it going to? Private equity is not returning capital like we thought it did. Do we give private equity more capital? How much do we give real estate? And a lot of pension funds are upsizing their fixed income portfolio given where rates are today. So what I think pension funds are doing the last year has been really developing a much more defined pacing plan that allows them to put capital out. And I think that's one of the things that's actually encouraging, because in the past, they really just had a lot of money, to your question, to put out into all of the asset classes without really giving a lot of attention to the pacing. So one of the things that does when you have a limited capital plan with limited dollars is a lot of these large pension funds have relationships with existing GPs that they've had for 15 years that have produced good performance. And so that makes it tough for new strategies and new entries to break into these large funds. They still have money, but what they're doing is they're funding their existing partners. And that makes it tough for new entries.
So Rob, you do a lot of things, including a lot of stuff on the debt side. And it seems like the freeze, sort of started when the Fed started raising interest rates, and, that sort of caused a repricing. And then we've had things go down, but now the 10-year, I think, is at 4.25. As you look at it and you talk to investors and potential borrowers or people looking to raise money, and they see that 4.25, 10-year, probably that means borrowing rates are around 6% plus or minus. How do people sort of look at it, like what it takes to make the numbers pencil out for them, and how does that impact equity capital flows going into real estate?
Sure. Well, just to take a step back, I sit on a credit committee for the Real Estate Roundtable, and we have a quarterly working call, and we had our quarterly working call about 40 days ago. So after the pivot, if you will, from the September cut. And I will tell you, just generally speaking, in the credit markets, the sentiment is much more positive, right? The availability of credit, of debt capital, is not the issue, right? It's not a liquidity issue. And I will take it a step further. Over the course of the last couple of years, the biggest, constraint in terms of the legs of the stool of the credit markets, right, has been the money center bank market, which I think everybody knows, right? The big domestic money centers, obviously, we all know they have a lot of office exposure that they've been working through. And from a net new originations perspective, they haven't been providing liquidity to the market. And that what that has done after 2.5 years of that is obviously it's been a drag on their net interest margins. And you're seeing a tangible change from that segment of the credit markets, the money center bank market, wanting to provide liquidity back to the market. That's something that's the last 45 days. So that's very much a positive going forward. I think as it relates to making sense of coupons that are in the 5s to the 6s, given where cap rates are, it kind of depends who you talk to, right? If you talk to the Odyssey guys, they're going to tell you, well, we're focused on unleveraged returns, right? So that's the way we're looking at it. If you're talking to a developer who's looking to go ground up, who's focused on yield on costs that are now on the 7s, right, that cost of debt becomes much more meaningful. So I think part of the answer, Jeff, is it depends on who you're talking to and what their goals are. Look, the market's had a couple of years now to start to recalibrate to a new world, right, a new environment. The days of 2% and 3% coupon debt is gone, and I think everybody understands that that's not coming back, right? Does the 10-year settle 3.5 to 4? Does it settle 4 to 4.5? Yet that remains to be seen, right? Everybody's got their own forecast. Everybody's, but none of us have a crystal ball, right? We know it's not going to be 3, and we hope it's not going to be 5 or 5.25, right? So I think the market has gone a long way to absorb and kind of recalibrate to kind of this new normal. I will tell you, when we saw the pivot, we saw the 10-year get down to 3.25. From our perspective, there started to be a pretty big pickup as it relates to elective refis, people looking a little bit more proactively at, maturity schedules, et cetera. I will tell you the latest disruption of 50 bips to 4.25 has a lot of people retrenching again, especially if you're a fixed rate borrower looking for longer term debt. And really what that's done is it's really made people focus on shorter duration from a borrower perspective, which has really been where the market is. Demand has been much more on the 5-year fixed rate than it has been the 10-year fixed rate. And as a result, spreads are probably a little bit more compressed on longer duration than they are shorter duration. But I think the market's view is, now that the pivot has started, let's kind of wait and see, do rates come in? Certainly there's a lot of room for spreads to compress, and spreads have been pretty stable, right? Spreads have been stable. They've moved in sympathy with corporates. We all kind of know where the corporate market is, but there's still a lot more room for compression.
Right. Well, yeah, you're talking about debt, and this sort of leads me into another question on the debt fundraising, because, for a while, everyone's been saying, hey, the best risk return, some people have been saying, is a debt fund. Everyone's got a real estate debt fund. And then more broadly, everyone I know in private equity, everyone I get bombarded with, hey, private credit's the way to go. It's the greatest thing ever, and everyone's raising. Is there that much money continuing to go into these private real estate debt funds? I know, Lindsay, or people sort of said, that's a little overdone. I want to play the equity side now.
I would say money is definitely flowing into private real estate debt funds. We're seeing it live in terms of our day-to-day, again, with a but. The but is investors' scrutiny is significantly higher, and every investor that I speak to and who had previously said, I'm excited about real estate credit, I think that's the way to kind of play this market, is now saying, well, how about the rate cuts? Are the opportunities still out there? Show me via manager A, B, or C. Show me their pipeline so that I actually believe that there are the same opportunities or close to, as exciting opportunities as there were in 2024 that will proceed through 2025. So I think 2024 was the year where you had investors who had never done real estate credit saying, I'm going to do it. I might not do it forever, but I'm going to do it for this vintage. And now you have some of those kind of retrenching, and maybe they made that investment in 24, but if they didn't, they're thinking a little bit more by saying, do I still believe that opportunity persists, or is now okay to just go into some sort of distressed equity play? So interest remains high. I think you'll see a couple more great announcements of credit fundraisers that close and that attract a significant amount of capital. But I think the investors are simply just putting the brakes on a little bit and saying, maybe if I didn't do it already, maybe I missed my window. And it's up to those GPs or sponsors to convince investors that they didn't miss the window and show them deals to prove that.
I know, one of the challenges in the real estate world, at least used to be to me was that this whole question is real estate debt. Real estate, is it credit? Where does it belong in allocations? You know, does it matter? And maybe more broadly, Mitch, you can talk about that question, but I think more broadly, you know, this question of our real estate allocations generally going up, down. I think you mentioned they're being eaten away by a few other areas. Heard a lot of institutions say, you know, real estate after getting, you know, offices and shopping centers, it's not doing what I want. I want more infrastructure, you know, and infrastructure's gobbling up some of the real assets allocation. You know, looking at CalSTRS and other peers, do you see real estate holding its own in allocations?
Yeah, I think the fundamentals of real estate will always have pension funds needing real estate in their portfolio. I think what's happened is with large value drops in office, which is held by a lot of pension funds, and the equity markets going up, and just the lack of capital going into the market the last year, most plans are at allocation. And they're pretty stable in terms of that. And I think the big issue for money going out is, again, this capital budget, everybody's being very conservative about the dollars that are going out across all the asset classes. Now, I think your first part of the question was about private credit. I think that's a very good kind of, where does it go? How does it fit? And at CalSTRS, where private credit fit was in each one of the asset classes. We talked a lot about putting it together in a single asset class, but private equity does it, infrastructure does it, real estate, of course, does it. Fixed income even has a private credit sleeve that they work, and we all work kind of across asset classes. So what happens, and what this is a challenge for private credit for real estate, is you can't make it too big of an allocation within the portfolio. And so if you're a mature investor, you've been in the business for a long time, you really don't have a lot of room for new private credit. That's been a real challenge for CalSTRS and other large plans, is I can maybe justify 10% because if it's at the right time, it beats my benchmark. It's safe, and if you do private credit in the short duration, you're getting money back pretty quickly. And that to me feels really good as an investor, but I can fill up very quickly on 7 to 10% with just a handful of partners. So that's a challenge, and we're a big investor. So 5 to 10% of $50 billion, it seems like a lot, but with 2 or 3 partners, we can get there pretty quick. So I think that's a challenge in raising capital in the private credit space.
You know, you talked about, we touched on the dreaded office question, you know, out there and the values, but maybe we could just elevate it to the broader, where capital is flowing into what sectors. I think it's been at least a decade since, you know, the beds and sheds, you know, living and industrial logistic. Maybe people would throw some meds in there to just make it rhyme in 3. But, you know, that's been such a big theme. Is that continuing? Is there enough room for all that money going in there? Or are you starting to see some people go, you know, maybe that was a good decade-long run. I should be thinking about something else that's getting too crowded. I just open that up to anyone.
Yeah, I'll start. I mean, I think by any measure, right, if you look at transaction activity and what's been happening and where capital is going, it's still heavily weighted towards multi and industrial, right? I mean, you can look at pretty much any allocation. Having said that, clearly there's been a lot of activity, and I'm sure Lindsay can speak to it in terms of, you know, LP conversations around the alts, right? Whether it be data center, whether it be student, whether it be senior, storage. And I think you'll probably head more in the direction of seeing, you know, these sponsors, these managers more strategy focused. But yeah, I think still clearly when you look at it in terms of on the ground transaction activity, it seems like industrial by far seems to continue to get the most attention. Going in yields are, you know, kind of by and large in the 5s. It becomes more market specific, sub-market specific. Southern California, what's been happening on demand, rents have softened. So you kind of got to go market by market. But I think from a general sector perspective, it still feels like industrial is probably the most favored nation, if you will, followed by resi. And then you got to take into account the alts. I mean, the numbers on the data center side obviously are they're staggering with what's happening with the hyperscalers.
Let me add to that a little bit. I think one of the factors that's going to drive a lot of the growth in the niche property type allocations from LPs is the change that occurred in September of this year for the inclusion criteria of the Odyssey. And for those who aren't familiar, Odyssey is the open-end diversified core equity index, where many of the open-ended funds, if they meet certain criteria, are eligible to be a part of. The key change that happened in September is that 6 property subtypes have been reclassified. So these 6 property types, which are all niches: single family rental, manufactured housing, student housing, industrial office, but additional word that's key is life science, and medical office. So those were previously called other, and they could be up to 8% of allocations in an Odyssey fund. Now they can represent 25% of allocations. So that translates to an estimated 50 billion of GAV that might flow into these sectors within the Odyssey funds. Now, why is this important if you're not raising an Odyssey fund? Because a lot of the public pensions and a lot of the consultants use that Odyssey benchmark to dictate how they will allocate their portfolios to those property types. So I think you're going to see a lot of LP capital flow into those sectors, not just with the Odyssey funds, but in other single strategy funds or other diversified funds that can now do a lot more in those sectors. And one of the sectors and one of the words that we have not said thus far, Rob, is retail. I was on the road this week. I was with 4 of the, 4 very notable LP allocators, and retail is top of mind for many. It's an area that they have very, very little of in their portfolio because arguably no one's done retail since 2020 when COVID began. And it's a sector that people believe has bottomed. So I believe, and I believe this because it's what I hear from LPs, and my job is to listen, is that retail is going to see a good amount of inflow of LP capital in 2025 and beyond.
Well, it's interesting because, I mean, retail, it's been probably a decade. For a long time, it was the poster child, bad, worst sector. Office has now clearly fallen into that camp. But everything I'm seeing, the fundamentals of the retail that survived has been really good and I keep track of the REITs. And as you know, some of the REIT that specialize, from Simon Properties and the big malls to the Kimcos, I mean, they've been just, their results have been really good, and their same store NOI. So you think people are waking up to that and seeing that? I don't know, Mitch, I don't know how you guys would look at it.
Yeah, so I agree with Lindsay. I think a lot of what drives new money investing for the large funds is the Odyssey benchmark that they're all using for performance. And industrial is a big component. It's the largest component. And so people are behind in industrial, and they've got to, if they're even a little bit benchmark aware, they have to be moving closer to their industrial targets. So that's why you're seeing a lot of industrial. But the other question to ask is, well, what are the other asset classes we think can beat industrial? And retail is one of those. It's been revalued. It's got good cash flow, and it's kind of what I call an industrial beater that you can put and add into your portfolio, and it's a value. It's kind of a value add right now. So I would agree with that in terms of investing, new money going out the door.
And is anyone starting to talk about, or is anyone go touch office or is it a decade in the wilderness like retail? What are people seeing out there, both, from the LPs, and Rob, you're a little closer to actual transactions, happening, not just with LPs, but sponsors or owners.
I'll just start kind of what we're actually seeing on the ground in terms of what's been trading. It's predominantly been smaller, under, call it 75 million. The primary profile has been a lender cooperated owner borrower sale, effectively a short sale. right, has been predominantly how things have traded. And the buyers have been overwhelmingly private capital, right? High net worth, non-IRR driven basis, long-term hold buyers, right? Because it's still very difficult to underwrite, stabilized occupancy. Where are rents? Rents are probably a bigger question even than stabilized occupancy, residual cap rates, right? And obviously, as we all know, office are capital intensive assets, which is what kind of a lot of people have been awakened to, right? And so, but when you have private buyers who can look at an asset in San Francisco and say, look, at $250 a foot, this is an asset that traded at $1,000 a foot at peak. And I can hold on to this, and over the next 15 years, I feel good about a stabilized basis at 400 a foot or whatever the numbers are. So that's on the ground what we've been seeing. Lindsay and Mitch obviously can speak to kind of the LP side. I will tell
Rob,
you,
can they get debt, or are they going all cash, or is
Yeah,
there
a lot-
seller financing from the lenders who are?
It's a great question. It's been a combination of all cash. There's certainly been all cash trades. There have been some that have been seller financed, but I will tell you, those have been kind of fewer and far between. Banks, the lenders typically have not wanted to provide seller financing. They'll certainly want that deal to go to market without it and see where pricing is, and then see what incremental additional value there may be if they provide seller financing. And then what's been financed third party has been pretty much all kind of private capital debt fund, high single digit, low double digit at low leverage. So it's ugly.
My addition, it jives with what Rob said. I don't hear it from what you'd call kind of the traditional LPs. They're just not ready to take that risk yet. And when you're thinking about investing in a fund, you're putting a time horizon on how you're going to exit that investment. And I think no one knows how you do that in this environment. How do you put a 5-year hold projection or a 7-year, exit cap rate on office when no one even knows what the cap rates are today? On the flip side, the one place I hear investors say, hey, I'd buy office. I can do it all cash if I need to. I can hold this forever and kind of close my eyes for the next 5 years. It's ultra high net worths. And they can take a very long-term view. They don't have to report a 3 or a 5-year return to anyone. And that can work for them. And I think, hopefully they'll do amazing by doing that. But I simply think for LPs making a decision to invest in a fund that might solely invest in office, it's a very hard bet to make as we sit today.
So that really gets to one of the questions we had, if the large pension funds are not, is more general to newer entrants, first time funds. But I think your office question, about high net worth, the sort of, question is, who else is, particularly for smaller, newer funds, where are the major sources of capital these days? If raising your own funds really difficult, I don't know if the allocator funds are still, able to do that, or is it really that high net worth, however you define it, up to ultra high net worth? Are you seeing those become bigger factors in the market?
I've definitely seen a very sizable increase in capital from wealth management platforms, RIAs, multifamily offices. I would say that peaked in 2022. It was really, some pretty high numbers of volume of dollars going out the door in 2021, 22. And some of that went to very large, well-known, established names. On the flip side, a lot of groups said, I need to show something different to my underlying clients. So I'm going to do a fund 1 or a fund 2. Like, I want something new and different. That has slowed just as a result of the lack of return of capital, how much money went out the door originally, and simply kind of the underlying capital being the retail LPs saying, I'm nervous, I'm reading headlines. So when you think about emerging managers, which I would say is someone trying to raise their first or second fund, or they've had high net worth friends and family funds, but this is the first fund that's going to look for institutional capital. It's really hard. It is. It's no secret that it's a very, very difficult fundraising environment, and competition's at an all-time high. There is a great opportunity out there, which is called the emerging manager programs. And I think that's one of the ways to get to kind of the big guys in a different channel. You can't go to STRS or PERS with a $100 million first time fund and get a look. It just, the numbers don't make sense. But each of these very large US public pension plans have adopted emerging manager programs, and some of them manage them in-house, some of them manage them with third parties. They each have different criteria that kind of is very clearly spelled out for what is allowable, what is not. And if a GP who's trying to raise money spends time understanding those and going to some of those events and speaking with those third-party advisors, I think there's potentially a path there.
And Mitch, did you, I mean, you said you had these big relationships, but did you look at emerging manager programs? And at least I recall some of the data I've seen, I think it's in the real estate and private equity, that first time and second time funds tend to be the strongest performers. And then people sort of get too big and too complacent, or whatever the analysis is of why, but they tend not to do as well. How did you look at that?
Yeah, we really since 2000 have not formally, but worked with emerging managers for property types that we really liked and funded joint ventures with new managers. Then probably 2010, 11, we formed emerging managers specific to fund new managers to incubate them to grow into these programmatic partnerships. And I think one of the keys to the question is, does that emerging manager have discretion? Because if they have discretion and they have money, they can actually continue to do business through this cycle, which is really important, versus does the large pension fund still have a say? And still, because if they do, emerging manager programs can be cut back just because of what's going on in the market today, just what we've been talking about. So I think, if I'm a new entrant, I'd want to know if there's discretionary money to that emerging manager program. So that would be,
I mean, you have money or you don't really have money. Yeah.
yeah,
And it's
I mean,
good to operate in the market with that uncertainty.
yeah, and I think there are a number of allocators, this is just a general comment, that have raised money over the last year, like large amounts of money that have money within funds that are seasoned allocators that still have money to do deals with partners. And it's just a matter of knowing who those large allocators that have been given discretionary funds that are still in the marketplace looking for that. That's just homework. I mean, that's just something that is going to take time.
I see. Since we sort of drifted into office, there's a question on that. It's sort of like the great question, the great imponderable. If corporate return to office mandates accelerate, do we think people will actually come into the office, and will that improve the office building values? Rob, are you seeing, I guess, in the underlying, your tenant rep people, your leasing people, are they seeing demand start to pick up, or is it still pretty patchy?
Well, Amazon had some big news. I mean, that's pretty profound, I think, for the market. And will that bleed over into Microsoft, et cetera? Look, I think globally, with the big tenants, if you asked our occupier folks, they would tell you, generally speaking, it's still been, slower. We'll see what kind of catalyst this may or may not be in terms of Amazon kind of forcing people back for, and will people leave, et cetera. So, we saw it try to happen a couple of years ago with some of the financial services firms. It didn't work out so well. So I think it's still a great question, right? And it speaks to, one of the reasons why institutional capital, one of multiple reasons why there's still a, feeling of it's a little bit early to really kind of, given the uncertainties out there, to deploy into that specific sector. And then I think, but office has been a very bifurcated market, right? If you look at One Vanderbilt in New York City, I mean, you look at the top 10% of buildings, well located, highly amenitized, newer vintage buildings. I mean, there's record performance, right? Occupancies are extremely high and rents are at record levels. And then you look at, kind of older vintage, the bottom 20%, that's where even if you look at kind of exposure across the Odyssey funds now and assets that they have, Doug Schwartz was just saying the other day, the vacancy is concentrated, very much in terms of, a smaller portion of buildings, right? And then it's that swath in between, right? That 70% of the market in between that, there's still, high levels of uncertainty. Look, I would say this, I would say some of the bigger, smarter institutional investors out there are studying office again. I mean, it's not like people aren't looking to figure out when and where is the opportunity, because there has been a generational shift, and that beta means that there will be the opportunity to make money.
I mean, the handful of trades, I mean, it's been very limited, mainly distressed, but things I'm seeing, and living in Chicago, I'm at the epicenter of one of the hated office markets. But things are trading 60, 70%, everything's 50 below, what it was 3 years ago, which at that drop, people are going to look and say, hey, is it, the proverbial catch a falling knife, or is it so cheap I can wait it out?
Yeah. Well, Chicago is a great example, right? Because the question there is, can you do, net effective positive rent, new leases, right? Capital, office assets are capital intensive assets, right? And so, it's a lot different evaluating an office asset in Midtown or in Century City than it is, in downtown Chicago.
Yeah. Well, I'll do one Stanford shout out while we're finishing up on office, which is for those of you who haven't looked at it. Nicholas Bloom, a professor of economics at Stanford, and he's co-leader of the work from home project, and he was studying work from home in 2014 before it was cool, and he sort of the leader in that. They publish a lot of work. It's available on the website. And for those of you who like to follow that and statistics and so forth about occupier demand and different views, Nicholas Bloom's a leader, and a Stanford professor. So we'll move on from there. One of the things in my career that always sort of bemused me about the institutional real estate world were these labels we had. We had core, and we had core plus, which was a little racier than core. We couldn't quite say how, but it was better. Then we had value add, which was a little more racier, a little more leverage. And then we had opportunistic, and we sort of had like value add development. We created all these things. So I guess two questions. One, where do you see the money going into of these labels? And then sort of secondly, sort of what do you think they mean these days? And, have return expectations gone up, or is core always 6 to 8% on leverage? Opportunistic's always 20 gross for the last 30 years, no matter what, we just sort of talk about how people are thinking about risk return type of vehicles.
Well, I'll jump in. I'll start. I think we've been talking about the reduced amount of capital in the marketplace. And what that does is it forces returns up. In other words, you have a lot of assets that you're looking at that are coming through the pipeline, and you're going to choose high quality assets that have higher returns. So I think just overall, we've seen returns being pushed up because there's just a limited amount of money for those available deals. So.
And Lindsay, are you seeing, are people, you touch a bit on the Odyssey, the traditional core, the closest thing to an index, open end. I mean, are you seeing money flow in and out of that? And is it going into, hey, I want, these higher returns, double digits. Now's the point in the cycle, so forth. Or is it spread out?
I'd say it's a lot of money trying to flow out of the Odyssey, and redemption queues have been at an all-time high. I've heard, they were above 20% of NAV. We're now at about 17% of NAV, but that's still, close to 20 billion or just over 20 billion waiting to exit. So you have that amount of capital that's trying to get out of core open-ended. But what's interesting is when I talk to some of those LPs, it doesn't mean they're trying to put all of those dollars into opportunistic. It means they're trying to put them somewhere else. And what a lot of them are saying, single strategy, core plus open-ended, or, you know, it's a lot about kind of picking sectors, picking property types, I think, versus having, you know, name your number, Odyssey fund investments that kind of all give you the same exposure at this point in time. The Odyssey is most heavily weighted to residential and industrial. Office, everyone's trying to exit, and retail is very slim. So when you look across the Odyssey in terms of what the exposures are today, and you think of an LP, they're kind of saying, do I need all of these? Or should I pick my winners and my losers and pull some dollars out and reallocate? So I think dollars are, you know, it's different among different investor types. Most of the public pension plans have a heavy weighting to core, and that's part of their mandate. They need to deliver, you know, they need cash, they need to pay their liabilities. On the flip side, your endowments and your foundations are targeting a higher return. They're really not typically core investors. They're value, you know, they're value driven. They're looking for value add and opportunistic returns. So it's very much, I would say it's bifurcated around investor type. But if you kind of tried to put all the numbers together, you'd say there's the money's flowing out of core and it's going to go somewhere else. But the answer is going to be very different for every portfolio.
That, let me pick up on the debt side of that, because, you know, when leverage levels were cheap, debt was very accretive to IRRs. And you know, a cynic, and even some academics have said, you know, that like a core plus fund is basically core, but with 50% leverage instead of 30, and much higher fees for the sponsors. And that, you know, and value add and so forth was 65%, and so forth. That so much of the return was not driven by real property alpha. It was driven by, you know, sort of leverage beta, to use the academic term. With interest rates so much higher and the amount of LTV lower, how that equation doesn't seem to work as well right now. And you really have to drive property value increases. How are you seeing, Rob, that, you know, people tailor their borrowing strategies and debt capital strategies in this environment?
Well, you kind of hit the nail on the head, right? And if your cost of debt is high, then what do you have to focus on? You have to focus on growth at the asset level, right? You have to focus on NOI growth. So when you know, think about industrial, right? Let's talk about the asset class that continues to see the most capital flow into it, right? You know, cap rates are in the 5s, right? Generally speaking. Well, where's your cost of debt? Well, your cost of debt's in the 5s to 6. So we still see negative leverage. So how does someone justify acquiring an asset at negative leverage, right? Well, they do it because of their underwriting growth, right? They're underwriting rent growth, right? They're looking for shorter duration WALT. They're saying, you know, I have a 30% mark to market on my rents and I can stabilize to X, right? So without underwriting growth, it doesn't work. The numbers don't make sense, right? And, you had started kind of the conversation today talking about kind of spot market. What are we seeing in terms of fundraising, right? Just to put some numbers on it to give everybody some context. Fundraising in the first half of 20, and Lindsay probably knows these numbers much better than me. I just have numbers from that I got in a presentation actually at ULI 2 days ago from Dan Kubiak at Investo, and I thought it was pretty interesting. Fundraising in the first half of 24 is the lowest across all strategies, was the lowest it's been since 2012. And the Odyssey
Lindsay, you're seeing the same, yeah. Yeah, okay.
Yeah, and Lindsay just
That's the
touched
stats.
on, the redemption queues on the Odyssey funds. It was over 20%. It's high teens right now. To put that in perspective, versus COVID, it was about 10%, and during the GFC, it was about 15% at peak in terms of the redemption queues, right? I think what's interesting, though, and this is a question probably for Lindsay and Mitch, it does seem like a lot of the redemption queues are for partial redemptions, not full redemptions. So I think that kind of supports the fact that it's not an exodus, back to some of your earlier questions, Jeff, away from a real estate allocation, in total, which I think gives a little bit of comfort. But, I think that is something that probably should be mentioned amongst all these redemption requests. These aren't typically full redemption requests. They're looking for partial redemption. And I don't know, Lindsay, what you take from that and how meaningful that is, but it's something that seemed pretty important to me.
I would agree. I think rebalancing is the key, or it's just, the LP saying, I need to get cash from somewhere. And if it's not coming back to me in those closed-end funds, well, I have to at least give it a try to get some out of the open-ended funds. So there are some LPs that have, told me, hey, if I have I don't know, let's just use a pretend number, $1 billion of exposure across the Odyssey, I might, and I have 4 different funds that I'm exposed to, I might ask each of them to give me 25% back just so I can get some cash in my pocket. But the market, I think the sponsors, the Odyssey managers are getting creative. They're figuring out ways to ask investors to rescind their redemption requests, to offer fee incentives to stay in the fund, because they need to know that they're going to have liquidity available on, a long-term basis. If they don't have inflows, which there are very few inflows into those funds, how else are they generating liquidity to manage the assets? So there are some changes that are occurring real time in terms of the sponsors getting creative with economic offers to get LPs to stay or to rescind, and then LPs maybe getting a little money out from other funds that hopefully allow them to rescind redemption requests in other places. And therefore, I think we see that percentage in the redemption queue come down across, throughout 2025. It's certainly never going to get down to 0, but it's not above 20 anymore. We're at 17 now, and hopefully by the middle of 2025, we're hovering closer to like a long-term average. And I think the market feels a lot better when we're in that place.
Great. We've had a couple specific questions on debt, so I'll turn this to Rob on, sort of levels and spreads on 5 and 10-year fixed rate financings. It seems like spreads are,
Sure.
for good quality are relatively tight by historical, but can you talk about if you had a 60% LTV,
Sure.
5-year, 10-year, where it'd be pricing out today?
Yeah, so for a best-in-class asset, right? The general account life insurance companies, which are pretty good benchmark, they track corporates. You're looking at, kind of moderate leverage, 50 to 60%. Those spreads on 5-year duration are typically around 140 over. I'd mentioned a little bit earlier that there's an overwhelming, predilection towards shorter duration, right? So you can actually probably get more compressed spreads, generally speaking, from the life cos for longer duration, right? Because they would like to see more longer duration money. So spreads could be as tight as 120 to 130 over, but we're basically in the mid ones. And then on the CMBS side,
That's tight. That's at
Yeah.
least from my memory, that's historically tight on the spread.
Yeah, and if it's a little bit, not best in class and a little bit, kind of more moderate leverage, it's probably in the higher ones. In the CMBS market, there's been great bond buyer activity, right? On relative, bond buyers are seeing good relative value in real estate, right? In CMBS. And so, AAAs on the conduit side are kind of in the 90 to 100 range. A single asset, single borrower AAAs are kind of more in the 120 to 130 range. And most pools are oversubscribed. And we've seen a new product from the street, and that has been on the conduit side, 5-year only pools. It used to be that you could do a 5-year duration CMBS deal fixed rate, but it was going to go into a 10-year pool. And bond buyers always hate that, right? Because it becomes much more difficult from a call protection perspective. So we've seen 5-year only pools. They've been oversubscribed, so there's been great interest in them. But yeah, and then on the bank side, with the banks becoming more active, it does become relevant again. Typical bank spreads for, higher debt yield, kind of north of an 8-9 debt yield. Those are in the high 100s, could be as tight as the mid 100s over SOFR. Again,
So for good quality assets, spreads are tight. I guess the question becomes almost binary, or if you don't fit into that, if you're the empty office building, it's closer to the next.
Yeah. I mean, to switch over to the debt fund side of the equation, right? For better assets, better sponsors at moderate leverage, those spreads start in kind of the mid 2s, and they get quickly into the 3s, depending on where it falls on the risk spectrum. There is capital for construction, right? There is capital for ground up. Industrial is still getting built. Multifamily is still getting built. There's bank capital for that. There's debt fund capital for that. Again, liquidity is really not the issue. It's more just the cost of debt and the market continuing to recalibrate towards this new normal and the most current volatility that we've seen in the bond market, right? That has kind of thrown a wrench in things again.
When we were talking about Odyssey, we touched on the question of appraisals, which is how, many investors are ultimately measured benchmark against, in all their private asset classes, against appraisals, which the more formal or academic benign side is appraisal lags, but they're has been when you have these sharp shifts, you know, people want to get out of the funds because they don't believe the appraisals. They think they're too high. No one wants to go in because they don't believe the appraisals. And then eventually, are people starting to believe the appraisals? Have they sort of has it adjusted enough, or are people still thinking, I'd rather be a seller at appraised value than a buyer? I don't know.
The $1 million
Mitch
question we
or
can call
Lindsay
it.
wanna.
You can see us all smirking, can't you? I think I think there's been a lot of questions about appraisals, and you just compare the private market evaluations to the public, and you know, both of them have their own intricacies, but they're not on top of each other. They're certainly apart. And I think that's just what investors are focused on. And so the scrutiny is high. But what, you know, what I think investors believe, and, you know, house views of many, is that we've probably bottomed in many of the sectors. And hot off the press as of this morning, NCREIF released the core fund performance results for Q3. And pleased to say, and I'm reading it straight off my screen, that says NCREIF turned positive in 2024's third quarter for the first time since 2022. And so the Odyssey was up 25 bips, which is up from negative 45 bips in the previous quarter. So, you know, we've had positive income return, but we had negative appreciation for more than 8 quarters. And seeing that pivot, I think it's almost just a mental switch for investors that says, wow, have I finally seen the end of the write-downs in the open-end world? And does that change my view going forward? Now, I'm not the economist. I'm not to say, you know, how those things were figured out. There's a lot of valuation work that goes into all of that, but that's what the stats say as of this morning.
And Mitch, at CalSTRS, and like, you know, all institutions have a growing allocation to private asset classes. Real estate's not the only one. Some people think private equity valuations are more artistic, to use a generous term, than even real estate. I mean, how did you guys look at it? I mean, if, you know, when appraisals, you can't sell at appraised value during times of disruption, was that a feature, or was it a drawback, or just as part of the deal?
I think when you're a long-term investor, and I underline long-term, I think you can't give a lot of weight to the appraisals. I think if you really look at how they're done, and especially for open-ended funds, I think they've come up with a great methodology of some really good people that get really good information. They make their best shot at valuing where we are in these kind of volatile markets. But I've always been impressed with the different groups that have done the valuation processes for the funds, but giving them weight, we just want cash back. And I think that was one of the challenges, is we were in the redemption queue like many other funds. And I think this is a big picture challenge for the open-ended funds, as an example, is that we thought we'd get our money back. We thought we'd get half of our money back. And I think it's going to rethink, a lot of investors are going to rethink, do I really want to go into open-ended funds if liquidity is important to me? Or should I spend the money and be a direct investor with a little more control of my exit, which hasn't necessarily turned out either way, because it's been hard to sell assets, but it might make you feel better if you have control versus no control.
Yeah.
And I think that's just one of the challenges for the open-ended funds, is they didn't deliver the liquidity that they promised and sold to the investors. And it's going to rethink the structure of many kind of investors' platforms going forward.
And I mean, as we speak about liquidity, Lindsay, one of the things your firm does is a big advisor, agent in secondary LP sales. I think they're mainly closed-end fund, but you can comment if you've sold any open-end fund interest for people who just need liquidity. But are you seeing that become more of a avenue? I think it's much bigger in private equity for investors who want liquidity. And are there ready buyers, or are they just going to get hammered on their valuations?
Unfortunately, like you said, it remains a much bigger market in traditional private equity. There's certainly been an increase in interest from LPs in selling their closed-end real estate funds on the secondary. Unfortunately, there has been very, very little trades that have actually occurred. The bid-ask spread simply remains much too wide. And a lot of the LPs are saying, I was trying to do this for liquidity, but I wasn't trying to do this to take a 25% haircut. Thank you very much. I'll hold this until I get my return of capital. On the flip side, though, something else that our team is a market leader in, and we spend a lot of time on, is GP-led secondaries. And this is really when the sponsor themselves says, I need to return capital back to my LPs, and what's a creative way that I can do this for them and solve that need. And so this is the GP proactively saying to us or another advisor, can I run a process? And, you know, this would either be called kind of a continuation fund or recapitalization, where I am running a process, Evercore is advising or whomever, to exit this portfolio as a whole or have another bite at the apple with a longer term hold opportunity. And all of this is with a mindset of delivering capital back to my underlying investors. And we've seen some examples this year where that has occurred. Fund investors have been given the choice to roll or to take their cash off the table. Historical average would say that about 70% of LPs typically take the cash in when they're given the opportunity. As of late, it's been about 90%. So when a GP runs a process and has a new buyer that's willing to come in on a longer term hold, that could be a secondary fund. It could be a long-term core buyer that just wants cash flow. It's very different. But ultimately, what's the same is that when LPs are given the option, they tend to say, I will take that liquidity back.
I mean, it's interesting to see, another technology that, I guess is much bigger, has been going on for a lot longer in the private equity world, the continuation fund migrating into real estate, on a selective basis. Well, we're about, there is another question. What sort of haircut are you seeing in those GP-led secondaries for those 90% selling? So, is the strike price set on appraisal, or is it set on where someone's coming in who's a true third party, or how's the price set?
It's a bidding process via the third parties. So you'll have active players, and it's really oftentimes it's the secondary funds who are buying LP secondaries, pools of, many LP secondaries. If you had a single position that was very large, you might have a direct LP saying, I love that fund, I want more exposure, I'm willing to buy it at a discount. But typically when LPs are doing this, you might have a mix of real estate, private equity, buyout, kind of all lumped together. And you have one of the big secondary funds that puts in a bid.
So it's a range of pricing depending on, but probably below appraisal. It's just a question.
Yes, below appraisal.
Okay, good.
90 cents or less on the dollar for real estate, I would say, but really the answer is very few of those have been trading.
We are almost right on our 1 hour time, and we've been able to answer questions as they've come in. I can't, we're within a week of the election, so I can't, not end with I'm not going to ask you to predict who's going to win. I'm not doing that. But, we are right on top of the election, and it seems like the capital markets in general, all of them, and the real estate markets, certainly as I look at REITs and so forth, no one seems to really care, or it doesn't, the markets have been remarkably stable, remarkably, liquid. Prices have been pretty buoyant. Do you see whoever wins making a huge short-term change in the sentiment, or is it more about, does the Fed raise rates or close rates, and anyone can run the country who wants to, as long as the Fed's friendly? So anyone want to address that one?
Well, I'll start a bit. Look, I think historically, from a transaction activity perspective, what you see, if you actually look at the numbers, is typically in advance of the election, it doesn't really have an effect on transaction activity. I'm not necessarily say the same on sentiment. I think if you talk to people and you say, what is your desired outcome? I don't think it's as much about who wins as much as it is about hopefully the same party doesn't take everything, right? Doesn't take the White House and the Congress and the Senate, because then you could have real change and you have, a lot of bad ideas out there. So I think the general sentiment is, from most people that I talk to, is it's not so much about who wins. It's more about, having some sort of divided government. So nothing bad can
Gridlock
happen.
is good, as much as we hate it, yeah.
Yeah.
Good, well, with that, unless Lindsay, do you want to comment? You took a deep breath there. I don't want to.
I'm gonna pass on the political commentary.
Good, that's probably a good idea. I want to thank all our panelists for your time and input and everyone who listened. This will be recorded, and we could plan to continue to do these, as well as many of you know, within various regions, we have regional gatherings. We have our annual SREC fall gathering on campus in 10 days' time. So, we welcome everyone's participation, Spire, and hope this has been helpful to you. With that, we'll sign off and hope you have a good day. Thank you.